Welcome to Real Estate Donation Academy. Today, we're going to walk through the tax deduction you can claim when you donate real estate to charity and the exact documentation required by the IRS to support it. The tax deduction belongs to the person or entity that owns the property at the time of donation. For tax purposes, the donation date is the closing date, or when the property is legally transferred to the charity. The signing date of the donation agreement at the beginning of the process is not the donation date. That owner could be an individual, a trust, an LLC, a corporation, or an estate. In the case of estates, the deduction belongs to the estate, not the heirs. If heirs wish to donate their interests and utilize the deduction personally, the property must first be transferred out of the estate to them and then donated. Donating property allows a charitable income tax deduction. It reduces your taxable income, not your taxes dollar for dollar like a tax credit. To benefit, you must itemize your deductions. For most real estate donations held more than 1 year, you can deduct up to 30% of your adjusted gross income each year. If the deduction exceeds that limit, you can carry the unused portion forward for up to 5 additional years. If the property was held for less than 1 year, which is uncommon, the deduction is generally limited to your cost basis, not the appraised value. Your deduction is based on the property's appraised fair market value, not what the charity later sells the property for, and not the property assessor valuation. The IRS relies on a qualified appraisal prepared under specific standards. For donations over $5,000, a qualified appraisal is required. The appraiser must be independent and experienced with the type of property being valued. The appraisal must reflect any restrictions on the property, such as easements, zoning limitations, use limitations, or lease agreements. The appraisal must be dated no earlier than 60 days before the donation and must be completed before you file your tax return. To claim the deduction, the IRS requires Form 8283. This form reports key details, including the property description, appraised value, donation date, and the charity receiving the gift. Form 8283 is a donor-prepared document. It is part of your tax return. The charity does not complete it for you. The process follows 3 steps. First, the donor completes the form. Second, the appraiser signs after completing the appraisal, confirming the stated value is correct. Third, the charity signs after the property transfer is complete, solely acknowledging its receipt as of the closing date on the form. If the form is incomplete, signed out of order, or missing required information, the IRS may disallow the entire deduction. After closing, the completed form, signed by the appraiser, should be sent to the charity for signature. A standard acknowledgement or thank you letter from a charity is not sufficient for IRS purposes. Form 8283 is the required document to support your deduction, with no exceptions. Before proceeding, we strongly recommend reviewing your donation strategy with your CPA or tax advisor to ensure everything is structured correctly. In our next video, we'll dive into the qualified appraisal, how to find one, how to optimize the value of your deduction, and the elements required by the IRS in the report.